Hello, everyone, and welcome back to the GMS Weekly podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 19 of 2026, and this week brought one of the most important shifts we've seen since the start of the Hormuz crisis.
That's right. The central theme this week is that diplomacy has finally re entered the conversation, but it has not yet changed the recycling market's reality.
Exactly. Brent crude fell sharply from its April 30th high of just over $126 per barrel to below $97 on May 6th, before settling close to $100 by May 7th.
And that move came after reports of a one-page memorandum being passed from Washington to Tehran through Pakistan. President Trump also suspended the U.S. naval escort operation in Hormuz, citing progress.
So on the surface, that sounds like a major de-escalation.
It does, but the important distinction is that this is diplomatic movement, not yet operational resolution. Tehran has confirmed receipt of the proposal, but key figures in Iran have already pushed back, and safe passage has still not been fully restored.
And that is why the ship recycling market is not reacting as though the crisis is over.
Exactly. The market has shifted from asking, will supply come, to asking, can diplomacy release supply in time?
And with only about 3 weeks left before the monsoon window closes, timing is now critical.
Freight is probably the clearest signal here. While oil prices corrected sharply, freight moved in the opposite direction.
The Baltic Dry Index closed at 2,991 on May 6th, up 12% from the previous week. Capesize earnings surged, with the Baltic Capesize Index reaching 5,074 and daily returns moving above $42,000.
That matters because dry bulk segments most relevant to recycling are now at their strongest levels of the year. So even if oil is easing, vessel earnings remain attractive.
And when older ships are still earning strong money, owners are not incentivized to send them for recycling.
Which brings us back to the core issue we've been discussing for several weeks now. The backlog remains in place.
Inflation is also beginning to show the full impact of the earlier war shock.
Pakistan is a key example. April CPI jumped to 10.9% from 7.3% in March, marking the first double-digit inflation print in 21 months.
And the State Bank of Pakistan responded with a 100 basis point rate hike to 11.5%, the first rate hike in 3 years.
Turkey also saw inflation move higher, with April CPI rising to 32.37%, ending the 3-month disinflation trend.
So even though Brent has pulled back, the inflationary impact of the shock is now arriving in domestic economies.
Currencies are also reflecting that uneven adjustment. The Indian rupee touched a fresh low around 95.27, before recovering to roughly 94.18 on the diplomatic headlines.
The Turkish lira weakened again to a new record low around 45.24 against the dollar, while Pakistan's rupee softened slightly to around 279.61.
Bangladesh remains the outlier in terms of stability, with the Taka holding around 122.90, still inside the same range that has defined Q2 so far.
So let's move into the recycling destination, starting with Bangladesh.
Bangladesh remains in the strongest position from a demand and pricing standpoint. Chattogram continues to lead the market, with local steel plate prices holding in the range of about $562 to $578 per ton.
The letter of credit pipeline also remains supportive. The delays and friction that defined the first quarter have now been largely cleared for several weeks.
That gives Bangladesh a strong financial and operational footing. Buyers are ready, financing is functioning, and pricing remains competitive.
But the problem is the same as before: the ships are not coming.
Exactly. The yards want tonnage, but owners are still holding vessels because freight earnings remain strong and the operational risks around Hormuz have not fully disappeared.
Bangladesh also has an important inflation print pending. With Pakistan and Turkey already showing clear energy-driven inflation, Bangladesh's April data will help determine whether Taka stability has insulated the local economy from similar pressures.
But for the recycling market, the immediate picture is unchanged. Chattogram has demand, it has pricing, it has the LC flow. What it does not have is enough supply.
Moving to India this week was all about the rupee.
Yes, India saw a sharp currency swing. The rupee moved to a fresh all-time low around 95.27 against the dollar, before recovering after the Brent correction and the diplomatic headlines.
That recovery is important, but it should be viewed as relief rather than resolution.
Absolutely. India remains heavily exposed to Hormuz-linked energy flows, with a large share of crude and LPG imports tied to that route. Any reopening would help, but the practical timeline remains uncertain.
On the recycling side, a long steel price is held in the range of about $422 to $436 per ton in US dollar terms.
That keeps India as the lowest price destination in the subcontinent. But India's real strength remains compliance.
More than 110 yards at a lang continue to hold valid statements of compliance, which keeps India highly relevant for regulated tonnage.
But once again, capacity is not the issue. Compliance is not the issue. Even pricing flexibility is not the issue.
The issue is candidate flow.
Exactly. The Brent correction has not released tonnage. The monsoon window is narrowing, and Alang is still waiting.
Pakistan is probably the most interesting market this week because its position has shifted from very strong to more complicated.
That's right. Pakistan's Gulf proximity premium is still important, and Gadani's pricing remains very firm. Local steel plate prices are around 190,000 rupees per ton, translating to roughly $679 per ton.
That is still the firmest absolute pricing position of the year.
But the inflation shock changes the texture of the market. April CPI at 10.9%, together with the rate hike to 11.5%, means Pakistan's earlier currency and stability advantage is now being tested.
The rupee has not collapsed, and in level terms it remains comparatively stable, but the pressure is clearly building.
At the same time, the diplomatic movement around Hormuz introduces a new risk for Pakistan. If a durable reopening does happen, the Gulf proximity premium that benefited Gadani could begin to erode.
So Pakistan's advantage has narrowed, but it has not disappeared.
Exactly. Gadani still has strong pricing, relevant candidate compatibility, and 3 HKC-certified yards operational. But the window for turning that structural position into actual transactions is now very tight.
Finally, Turkey remains largely detached from the subcontinent pricing dynamic.
The lira has weakened again to a fresh record low, and inflation has moved higher. April CPI at 32.37% makes the central bank's year-end target increasingly difficult to reconcile with current conditions.
In terms of recycling prices, Aliaga remains far below the subcontinent, with levels around $270 to $292 per LDT, depending on vessel type.
That leaves Turkey structurally uncompetitive for mainstream tonnage.
Its relevance remains limited to EU-regulated vessels where compliance requirements can outweigh the price gap.
So stepping back, the market message this week is very clear.
Brent has broken lower, diplomacy has restarted, and currencies have adjusted. But none of that has yet translated into recycling supply.
Freight is too strong, the Hormuz risk is not fully resolved, and the monsoon window is almost closed.
So the backlog holds.
The question for the next few weeks is not whether there is demand. There is. It is not whether yards are ready. They are.
The real question is whether diplomacy can move fast enough to change owners' decisions before the window closes. And based on the current freight market and the remaining uncertainty around safe passage, that still looks unlikely. That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe.
And see you next week.